how the world is reacting and absorbing the Fed rate hike and the commentary thereof. James Glassman from JP Morgan Chase and Company joins us in the show right now, and we've also got on board with us Ryan Sweet from Moody's Analytics. Ryan, if I could come to you first, what is it that you're making of the Fed move? Seems like it's much on expected lines, the 25 bips hike, but the commentary which is coming.
Yeah, I don't think it was a big surprise from the Fed. I mean, everyone was penciling in a rate hike, and I think the strength of the economy justifies a move in December. I think the relative disappointment was, I don't think the Fed sounded as dovish as the markets were anticipating, but I think we've had this glaring disconnect between where markets think interest rates are headed and where the Fed expects to put them. And I think within the statement, the Fed left in gradual. Maybe if they had a mulligan, they would remove that to sound a little bit more dovish. But I think what markets really wanted to hear was that the Fed is going to be overly data dependent next year. I think that's what's going to come to fruition, and maybe that just didn't come across in today's communication. But overall, I think the Fed, they're not going to be reckless. If they're going to listen to the economy. If it needs an extended pause, they'll pause. And I think that's what you're going to hear more and more from the Fed, over the next several months.
Yeah, that seems to be the narrative, Ryan, because maybe they've not put it out as explicitly that there are imminent growth concerns, but I think in between the lines, there is a sense of caution that, would you say, has been marked through this commentary?
Yeah, I mean, Fed's striking a little bit more of a cautious tone. I mean, financial market conditions have tightened. That's going to weigh a little bit on growth next year. But the U.S. economy has a tremendous amount of momentum heading into next year. I mean, we still have some fiscal stimulus in the pipeline via deficit-financed increases in government spending. That's going to help keep the economy growing above trend. And I think, what's kind of been lost in the shuffle is that some tightening in monetary policy. So the normalization of interest rates in the U.S. It's supposed to be painful. It's not supposed to be a walk in the park. Financial market conditions are supposed to tighten. The Fed's trying to slow the economy over time from growing from 3% down to 2%. They want trend job growth to go from, say, 175, 200,000 per month down to 100,000 per month to stabilize the unemployment rate. So the Fed's trying to slow the economy down in an effort to extend the life of this expansion. So, these rate hikes are going to be painful, but, again, the Fed, they're going to be very, very data dependent next year. I do think they're going to pause in March because given the drop in oil prices, some slide in inflation expectations, I think inflation is going to, fall a little bit short of the Fed's expectations in the first half of this year. Then you throw on top of that Brexit uncertainty, and then also, this timeline for U.S.-China trade negotiations ends in March. So that's going to be a lot of, moving parts for the Fed to absorb and, gauge a sense of how that's going to affect the economy. Therefore, I think they likely pause in March. But again, if the data is stronger than they expect, they'll move ahead with a rate hike.
Right. James, why then are the markets disappointed?
I think the market's confused by what the Fed is trying to do, because people have been living for a decade with very low interest rates, and they sense that what's going on here is the Fed is going to keep raising interest rates until the economy contracts. Well, that makes no sense, because all the Federal Reserve is trying to do is remove stimulus that's no longer needed. And if the market is having such problems with that process, then the market doesn't belong where it is, or they don't understand what the Fed's trying to do. I think the thing that's really significant to me is if you go back to the beginning of this year, with all the fiscal stimulus that the U.S. put in place, the big fear in the market, or among economists, and I think including at the Fed, the big fear was that this might be overheating the U.S. economy. And the fact is that's not really played out. Inflation is not going anywhere, and I think the Fed is showing you that it's willing to very gradually change its mind about where the full employment level is. And frankly, when I see the Fed doing what it's doing and going against the grain of all the hysteria about Fed policy, it makes me feel more bullish about the outlook for the U.S. economy and the outlook for the global economy, because the big danger right now, our history tells us that when the economy gets back to full employment, we never stay there for more than 1 or 2 years. And one of the reasons why that happens is because the Federal Reserve keeps rates too low too long, and it starts creating problems and stresses in the system. So I think if the Fed state keeps its eye on the state of the economy and it can prolong the life expectancy of the current expansion, it's going to be good news for everybody. And at the end of the day, it'll be fine for the equity market. I can't remember a period when there's been so much hysteria about a gentle move by the Fed. And, the Fed doesn't know what the future is going to look like. And honestly, if the economy did slow down in the coming year, that would be a positive thing for the U.S. economy, because we're already at levels of unemployment that are extremely low and below this Federal Reserve's notion of where full employment is. And clients are complaining, business clients are complaining, they're having a hard time finding people. We have 7 million jobs that are unfilled. So this is not, this is a perfectly sensible thing what the Fed is doing. And honestly, I think it is more positive. It's more constructive for the future if they continue to move in this way, in a very cautious way. And I think they are being very cautious. So, I think it's very constructive. And I don't honestly know why the equity market is having such a problem with it, except that it is an expensive market. And honestly, we're only 15% off of the all-time record high that we reached 2 months ago. So what has changed so much in 2 months? I don't know.
Okay, I guess time will tell. James, Ryan, both of you, thanks so much for joining in this morning and really analyzing what Fed's move and the commentary means for world markets.